Hi everyone. Because we've been seeing all these Eurozone emergency meetings recently, I thought it would be only appropriate that the Economy Watch issued an emergency update on the zone's last emergency meeting, now that the dust has had a chance to settle from it. Before I get into summarising where we are now following last week's emergency band-aid applying session, I thought I would just touch on something I first drew your attention to several months ago. The Wall Street Journal's bar graph of international bond yields. Originally the graph topped out at 7%. This level of yield is regarded as the upper limit for sustainable debt repayment. But then as the crisis developed, and we began to see countries breaching this barrier, the Journal felt compelled to extend this limit so countries living on borrowed time, as well as money, could still be included within their graphical representation. The ceiling was first increased to 11%, then after some weeks went by and Portugal, I believe it was at the time, breached this new barrier, it was increased to 20%, and several weeks later again 30%. I have to tell you today that it now stands at an insane 40%, as a result of Greece's 2-year paper rising last week to an astonishing 33% during the summit crisis meeting. These levels are just beyond belief and starkly illustrate the gravity of the situation facing Europe's perilous public finances. In fact, it was these new highs that led to US ratings agencies Fitch and Moody's further downgrading Greece's debt to a level indicative of certain default. In fact, the US ratings agencies have been scuppering plans for the Greek bailout by their strict interpretation of the term default. As a result, Mrs. Merkel and co. want to set up their own European-based ratings agencies, which would no doubt be kinder to the struggling peripheral countries' plight, as if such an outrageous move would carry any credibility whatsoever with the markets. One emergency meeting after another is guaranteed to spook the markets. If we didn't have all this alarmist talk out of the US about the debt ceiling, then the euro would no doubt be trading at much closer to 1.28 to 1.3 against the dollar. The most alarming thing about this whole rotten business is the total inability of the ECB and European finance ministers to keep ahead of the curve. For example, recall that it was some 18 months ago when it became clear Greece would need a second substantial bailout. Yet it has taken 10 fraught meetings over the course of a year and a half to finally make the extra funds available for Greece to use. The new deal results in, among other things, a substantial extension of up to 40 years for the longest dated Greek paper, and many shorter maturities doubled. And remember, during this 18-month period, whilst Mrs. Merkel and co. were concentrating solely on Greece, the contamination spread to Portugal, Spain and Italy. Bond prices picked up again in the wake of the final announcement. But how much of this recovery was due not to natural market reaction but simply to covert ECB support is anybody's guess. In any event, however, yields on Italian bonds have not settled back to where they were before the crisis. They remain at the time of writing some 75 basis points higher, a fact that would suggest that we are by no means on the path towards any kind of sustainable solution for the single currency, and in truth only deeper in the mire. As a matter of interest, German bullion dealers were paying well above the market price for gold last week. They had to set their own premium over and above the published spot price in order to cope with demand from anxious Germans eager to ditch their euros for the safety of the yellow metal. This kind of behaviour amply illustrates how little faith the Germans have in their adopted currency. In fact, clueless commentators who claim that Germany has done very well out of the euro, so it's only fair they should pay more into the kitty, are talking nonsense. This rubbish is spouted by people who have probably never even been to Germany, nor spoken to any German people directly. Almost all the Germans I have spoken to personally off the record have told me they hate the single currency and long for the old days and the return of their beloved Deutschmark, which they equate, not surprisingly, with prosperity and stability. Political deals of the kind we saw last week are only one part of the equation. Merkel has to square this approach to the German taxpayers. Not only that, but the Greeks have to go back to work, and work damned hard. Can you seriously see this happening? Of course, given the machinations currently surrounding the US debt hitting its ceiling as the August the 2nd deadline approaches, The euro is being seen at present as the lesser of two evils and is enjoying some temporary support versus the dollar in the forex markets. But I guarantee you this resilience will be only temporary. German Finance Minister Wolfgang Schäuble has himself admitted only today that one summit meeting won't fix the broken euro, and to expect further trouble down the line. I think we can look forward to a very interesting autumn in the bond and forex markets this year. With none of the critical issues surrounding the single currency resolved, and the focus of attention now shifted firmly to Spain and Italy, the tensions within the global financial system can only mount. Join me again next time.